Upside and downside risks. Downside risk refers to the possibility that actual outcomes will be worse than expected, resulting in financial loss, operational disruption, or reputational damage. These risks typically involve events that provide no opportunity for gain, such as fire damage, theft, system failures, or legal liabilities. Organizations manage downside risk primarily through risk mitigation techniques such as insurance, internal controls, compliance systems, and contingency planning. Effective downside risk management protects assets, ensures business continuity, and reduces exposure to catastrophic losses. In practice, organizations must identify potential loss events, estimate their likelihood and impact, and implement preventive and corrective controls that limit the probability or severity of adverse outcomes. Upside risk, often referred to as speculative risk, arises when outcomes may be either better or worse than expected. Many business decisions contain this two-sided uncertainty. For example, launching a new product, investing in technology, or entering a new market could produce higher profits than anticipated or lead to losses if the initiative fails. Organizations deliberately accept upside risks because they offer opportunities for competitive advantage and improved returns. Management therefore evaluates the potential rewards relative to the associated risks before committing resources. Strategic decision-making often involves balancing the likelihood of negative outcomes against the potential value creation from successful initiatives. Effective risk management recognizes that both upside and downside risks must be evaluated when making strategic and operational decisions. Organizations that avoid risk entirely may achieve stability but are unlikely to generate innovation, growth, or competitive advantage. Conversely, excessive risk-taking without proper analysis can threaten financial stability and organizational survival. Therefore, managers assess risk through structured frameworks that consider probability, impact, and alignment with organizational objectives. By understanding both positive and negative potential outcomes, organizations can pursue calculated opportunities while maintaining acceptable risk exposure and protecting long-term value for stakeholders. Risks arising from internal and external sources. Internal risks originate from within the organization and are usually associated with internal processes, systems, employees, or organizational structure. These include operational failures, fraud, employee misconduct, system breakdowns, poor internal controls, or ineffective management decisions. Internal risks are often considered more controllable because the organization can implement policies, monitoring mechanisms, and internal audit functions to mitigate them. For example, weak procedures for financial reporting may lead to fraud or misstatement of accounts. Organizations therefore establish strong governance structures, segregation of duties, internal audits, and performance monitoring systems to identify and manage internal sources of risk effectively. External risks arise from factors outside the organization's control, such as political developments, economic changes, legal regulations, market competition, technological advancements, or environmental events. These risks may significantly influence business performance even though they cannot be directly controlled by management. Examples include changes in taxation policies, economic recessions, new regulations, or natural disasters. Organizations respond to external risks through strategic planning, environmental scanning, and scenario analysis. By continuously monitoring the external environment, companies can anticipate potential disruptions and adapt strategies to maintain competitiveness and operational stability. Risk identification requires organizations to analyze both internal and external risk sources systematically. Internal risks often relate to operational processes and governance failures, whereas external risks arise from environmental, regulatory, economic, or technological changes. Effective risk management frameworks integrate both perspectives by using risk registers, risk assessments, and monitoring systems. Managers evaluate how internal weaknesses might amplify external threats, such as poor compliance systems increasing exposure to regulatory penalties. By combining internal control mechanisms with strategic environmental analysis, organizations improve their ability to prevent losses and respond quickly to emerging threats.